All right, today we're diving into the latest quarterly results from Avery Dennison. Now, you might not know the name off the top of your head, but I guarantee their products are all around you. So, how did they do this quarter? Let's get into it.
So, who exactly is Avery Dennison? Well, they're a huge global player in what's called materials science. Think about the labels on, well, just about everything: shampoo bottles, shipping packages, you name it. But, and this is the really interesting part, they're also a big deal in digital ID tech, like the RFID tags that let companies track their inventory in real time. Their whole tagline, Inspired Brands, Intelligent World, really nails that mix of the physical stuff we touch and the smart digital world.
Okay, let's zoom in on the big picture for their third quarter. If I had to sum it up in one word, it would be resilience. Avery Dennison managed to post some really solid results, even while navigating some pretty choppy economic waters. And you don't have to take my word for it. The CEO himself, Dion Stander, used two key words here: solid and dynamic. Solid is great. That means they're hitting their numbers. But dynamic environment? Yeah, that's classic CEO speak for things are challenging out there. This really sets the stage for a story about performing well against some serious headwinds. So what does solid actually look like in dollars and cents? Well, adjusted earnings per share, or EPS, landed at $2.37. The key thing here is that it's not only up 2% from last year, but it also beat what the analysts on Wall Street were expecting. That's a clear win. But here's where we start to see that dynamic environment the CEO was talking about. Total sales hit $2.2 billion, which is up a little bit. But look at the organic sales number. This is the one that strips out any acquisitions and shows you how the core business is really doing. And it was basically flat. That tells you that while the company is managing things well, the overall market isn't exactly giving them a boost. But, and this is a big but, that flat number on the surface is hiding a much more interesting story. Because when you look inside the company, there are two very different things going on. It really is a tale of two segments. So let's meet our two main characters in the story. On one side, you have the materials group. This is their traditional, massive business, the powerhouse that makes all those labels and materials. And on the other side, you've got the solutions group. This is the innovation hub, the part of the company focused on high-growth areas, including all that cool digital tech. And boom, this chart just lays it all out, doesn't it? The huge, established materials group actually saw its sales shrink by almost 2%. Meanwhile, the smaller, more innovative solutions group grew by a really healthy 3.6%. You can literally see the company's internal engine shifting right here. So what was holding the materials group back? It actually wasn't the amount of stuff they sold. Their volume was up a little. The real problem was pricing. Because of deflation in the market, they had to lower their prices, and that basically wiped out any of the gains they made from selling more product. It's a perfect snapshot of how a tough market can hit a mature business. Okay, so while the materials side of the house was wrestling with pricing pressure, the solutions group was just firing on all cylinders. So what exactly is fueling all that growth? The growth is really coming from their most advanced high-value stuff. You see here their Vestcom and Embelex lines were both up over 10%. That's fantastic. And their big strategic focus intelligent labels saw some really solid growth too. This isn't just random growth. It's targeted, strategic, and happening in all the right places. So what in the world are these intelligent labels we keep talking about? It's all about RFID technology. Think of them as tiny, smart trackers that connect a physical thing, like a pair of jeans in a store or a pallet in a warehouse, to the internet. This lets companies track everything with incredible accuracy, which is a total game changer for managing inventory. It's really the heart of their whole intelligent world strategy. Okay, so you've got this steady, massive business on one hand and a fast-growing, innovative one on the other. So how is the company actually using its money? Because, a company's capital strategy really tells you what its priorities are. First thing to notice, they are taking care of their shareholders. I mean, they returned $670 million just this year through dividends and buying back their own stock. That shows they're financially healthy and really confident in their ability to generate cash. But they're not just handing all the cash back. Nope. They're also investing it to grow even more. They spent $390 million to buy a company called Taylor Adhesives. This shows they're striking a balance, rewarding investors now while also placing smart bets on the future. Now, you might be wondering, is all this spending and buying back stock a little risky?
Well, the numbers say no. Their balance sheet is in great shape. This metric right here, their debt ratio, is just 2.2 times. In simple terms, that means they have a very strong and flexible financial position, which is exactly what you want to see.
All right, so Q3 was a solid quarter. But what's the plan for the rest of the year? Well, the company gave us a pretty clear look at what they're expecting.
For the final quarter of the year, they're forecasting adjusted EPS to be between $2.35 and $2.45. Remember, they just posted $2.37. So this guidance is telling us they expect a stable and consistent finish to the year. It's a message of, we've got this, expect more of the same solid performance. So to wrap it all up, Avery Dennison showed some real resilience this quarter. Their massive, traditional business held its ground in a tough market, while their high-tech solutions business grew like crazy. And that leaves us with the big question, right? As we watch this clear shift toward technology, can the intelligence side of the business go from being the exciting growth story to becoming the main event for the entire company? That's what we'll be watching.